Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. In this session, I want to address a common issue in small business valuations, especially for SBA lending: whether unreported cash can be considered when calculating free cash flow. Let me be clear. It cannot. Let's walk through why. A core principle of business valuation is that we must rely on verifiable, legally reported financial information. When a business owner talks about off-the-books cash, it doesn't matter how convincing they sound. If it's not on the tax returns, we can't use it. The Internal Revenue Code defines gross income broadly. Under IRC Section 61A, it includes all income: cash, check, barter, you name it. Failing to report income is illegal. If we include unreported cash in a valuation, we're admitting the business committed tax fraud. That's serious. Under IRC Section 7201, willfully evading taxes is a felony, with fines up to $100,000 and up to 7 years in jail. Submitting false tax documents is also a felony under IRC Section 7206, with similar penalties. As valuation professionals and SBA lenders, we're ethically and legally required to use only reported, documented, and verifiable information. SBA SOP 5010-8 mandates tax return verification. That means the business value comes from what's legally reported, not what someone claims on the side. Now, some sellers say, but the business is worth more because of all the cash we didn't report. That's a flawed argument. Here's why. The seller has already been compensated. They didn't pay taxes on that income. For example, if a seller hides $10,000 in cash and avoids a 30% tax, they keep an extra $3,000 in their pocket. That's a personal gain to the seller, not an asset that transfers to the buyer. And let's address the seller's perspective head-on. Some think a buyer will pay more because they can keep underreporting cash. Wrong. Buyers can't legally or safely rely on unreported cash. It risks IRS audits, penalties, or jail time. Plus, lenders like the SBA won't finance a deal based on unverifiable income. Ethical buyers won't touch it. Moreover, there's a critical problem. We can't verify unreported cash. There's no accounting trail. There are no bank deposits to check. There are no reliable records, just stories, guesses, or self-serving notes. Even employees or partners often disagree on how much cash was really brought in. It's speculative at best, dangerously misleading at worst. And if the seller was willing to lie to the IRS, who can put you in jail and seize your assets, how can you be sure they aren't lying to you as well? Professional valuation standards like USPAP Standards Rule 1.4 and AICPA SSVS 1 require sufficient, relevant, and reliable data. If it's unverifiable, it doesn't qualify. If we credit a business with unreported cash, we're speculating, not valuing. That undermines the integrity of the valuation and exposes lenders to serious risk. In closing, here are the key takeaways. Unreported cash is illegal. Including it relies on fraudulent data. The seller has already benefited from avoiding taxes. Unreported cash cannot be verified. Professional and SBA standards prohibit its inclusion. Always remember, if it isn't on the tax return, it doesn't exist for valuation purposes. Thanks for joining us for this episode of the Valuation Desk. At Highland Global, we bring decades of hands-on experience to every appraisal we deliver. SBA lenders trust us because we understand what's at stake: accurate, credible valuations that withstand scrutiny and support sound lending decisions. With thousands of reports under our belt, we don't just meet expectations, we help set the standard. Our deep knowledge of SBA requirements, valuation principles, and industry-specific nuances makes us the go-to choice for lenders who demand expertise they can rely on. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.